Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US Credit and Global Market Engagement at Informa Global Markets. I'm here with my colleague and co-host, Bruce Clark.
Morning, Shanks.
Head of Rates Market Coverage. Welcome, Bruce. Today, we will discuss the state of private credit markets, which have been in the news a lot lately. Private credit, to me, is not just one thing. It has many different forms, but the more visible or public portion of it is seeing some stress, which is raising questions on whether there is more that can't be seen than what is being seen. With the private credit universe valued at nearly $2 trillion and expected to double in the next 2-3 years, it is an asset class whose health and smooth functioning is vital for global financial markets. With problems showing up in visible portfolios, questions are now being raised about the credit ratings backing them. Is there proper due diligence? And are we facing some sort of financial contagion? We'll be asking answers to these critical questions to Meghan Neenan. Hi,
Hello,
welcome,
thanks for having me here today.
So Meghan is the managing director and the North American head of non-bank financial institutions. So the expert on private credit. And so Meghan's coverage includes investment managers, business development companies, consumer and commercial finance companies, leasing companies, securities firms, and financial market infrastructure companies. Prior to joining Fitch in June 2006, Meghan was an equity analyst at Morningstar, covering companies in the financial institutions industry. She began her career as a bank examiner at the Federal Reserve Bank of New York. So she knows everything. And analyzing a wide range of institutions from small community banks to large complex banking organizations. So welcome, Meghan. Thank you very much for finding the time to join us on this one. So I'll kick off with the questions. I think I'll start with one of the most simplest questions ever, and yet complicated. What is actually private credit? Like, what are the different forms of private credit, and is it still continuing to grow? What is the kind of size of this market?
Sure. Yeah, I mean, in the broadest sense, it really is anything that's originated outside of the banking universe. So, you mentioned I run the non-bank financial institutions team. We have a bank team at Fitch as well, and an insurance team, and anything that doesn't fit neatly into banks or insurance comes to me. So in some ways, everything that we do is private credit. We look a lot at, Preqin data. They kind of have a $2.4 trillion number for private credit at the end of 2025. Almost half of that is made up of direct lending. And then that's about $900 billion or so, according to their estimates. And then you have business development companies, which are $500 billion. So I think a lot of people tend to focus on direct lending when they talk about private credit. It is the more transparent corner of private credit, especially BDCs, because they have to file public, statements with the SEC and everything. But that area has certainly grown considerably, and that has driven the growth in private credit since the global financial crisis. Right. We will see if that continues, because I know we'll get to this later in the conversation, but we're seeing redemptions in some of those vehicles. But I think there's still a lot of institutional interest in direct lending. Beyond that, there's a lot of other things that fits into that: subscription facilities, NAV facilities, opportunistic credit, fund to funds. But you also have asset-based finance. And I think that is what we think is kind of driving more of the growth over the next 5 years. And so that's just a lot of things. It's a huge catch-all for, mortgage facilities, music royalties, auto lending, you name it. It's a lot of things that have traditionally been originated in the bank universe. and have kind of slowly, gradually moved into the non-bank world as banks have been more focused on kind of capital efficiency. So there's a lot in that private credit number. And I'm sure that everyone can agree that the $2.4 trillion number is wrong because nobody really knows how much is in there, but we know it's big and it's growing.
And you mentioned that, NAV facilities. And so these are all banks lending to private credit to lend to the companies or the institutions which are not getting access from the banks, right? Like that's how it works?
Yes. I mean, like a NAV facility, for example, could be an insurance company providing a loan to a fund.
Right.
And so it's not being originated by a bank. And so, yeah, we've seen NAV facilities grow in particular over the last few years because the private equity realization cycle has kind of lengthened. So the funds are holding capital for a longer period of time. And so they have been using NAV facilities to maybe continue to invest in those companies to increase the value of some of those investments, or maybe to distribute some of the fund capital back to LPs in a bit more accelerated way.
So Meghan, you also mentioned about regulatory capital, right? Like this is the capital banks have to keep as a buffer against some extreme circumstances. So what is a history behind that? Like why did private credit grow because of regulatory capital reasons?
Well, certainly the biggest catalyst was the global financial crisis. So regulation for the banks changed considerably coming out of that. There was also, there was changes in the capital rules or how they calculate risk-weighted assets. So there's different risk parameters assigned to different categories of loans, and then they have to hold a certain amount of capital against that. And so there were revisions to that coming out of the GFC. There was also leveraged lending guidance, which was limiting banks' ability to lend to corporations above kind of 6 times debt to EBITDA. And so the private credit market really expanded to just kind of fill the void. And beyond that, there's been other catalysts kind of along the way. You've seen banks in and out of the syndicated market. You've seen rates come down, certainly around COVID. And so that was insurance companies and other kind of institutional investors looking for yield. So where can you get a better yield in the private credit space? And so as that has happened, I think private equity sponsors, at least within the direct lending universe, have gotten more and more comfortable with the durability of private credit. So you see the syndicated market open, closed, open, closed. The private credit market is open, even though there's headlines now, and there's certainly a lot of discussion about potential stress there. There's still a lot of dry powder to put to work. And so I think that durability is key, the privacy, the certainty of close. There's a lot of benefits that the private credit market can offer. And so that has helped fuel, and we think will continue to fuel the growth there and the sustainability of private credit.
Hey, Meghan, quick question: Is private credit is it subject to cycles like normal credit is, or are you in such a growth phase that it sort of ignores the general cyclicality of credit in general?
No, it's definitely subject to cyclicality, and it really, if you think about it, this is all things that banks have done historically, right? And if you think about the people that are working in private credit, at least the people that are my age and older, a lot of them got their start in the banking universe, right? They were originating the same kind of paper at banks, and now they've moved to the private credit space where the growth is more meaningful potentially, and there's more flexibility. But yes, there's definitely cyclicality. We've been rating BDCs, for example, at Fitch since 2005. There are, they're dependent on the M&A cycle, what's happening in the capital market. So there's definitely credit cycles that we've seen, certainly in direct lending and some of these other asset classes as well.
But does it change? Like there is a lot of talk about regulatory capital on the banks being reduced, right? Like how does that play into all this?
Yeah. There definitely have been revisions to that for sure. And I think that's a big question. Does that mean the banks just kind of get back into it in a more meaningful way? And we've looked at this a lot. And from a regulatory perspective, the banks have actually had to increase the amount of disclosures they have around private credit, private equity exposure, starting with their call reports in January of 2025. So we've gotten a little bit more information about what the banks are doing. But if you think about their capital efficiency, which is what they're focused on, is kind of driving return on equity, it is more efficient for them to lend to a warehouse facility, for example, than it is to just lend directly to whoever, the mortgage itself, right? The risk-weighted assets are more attractive. They're higher in the capital structure. They're kind of collateralized by a diversified pool of mortgages. And I'm just using mortgage as an example. You fit the asset class in there that you want. And so from an ROE perspective, it is more efficient for them to kind of lend that way. And so we don't see there being a meaningful shift back to the way it was before. So
right. But does that defeat the purpose of reducing regulatory capital for the banks? Like if the idea would be to get them more involved in lending rather than being, subject to taking money from elsewhere, which probably is more expensive, I guess.
Yeah, I think they'll do more on the mortgages, but it also gives them more capacity to do this type of lending to private credit providers. And you've seen that increase significantly. I mean, I think the 5 buckets that are part of these new disclosures that the banks are having to kind of do, it's up like 35% year over year from end of 2025 to from end of 2024. So that kind of lending for them is certainly increasing meaningfully. And I think that's where they're kind of focused.
Is that why they, I mean, not to sound cynical, but is that why they were in some of these bank earnings calls this week, they've downplayed some of the headline risks that you're hearing lately. I mean, there's obviously a business motivation if they're expanding that, that side of their business. Do you think are they talking their books? I guess that's my question. Are they talking their books, or are they genuinely sanguine about the sector?
I don't think there's a lender that doesn't talk their own book. Right. I think that's a given. But I would say that I do think they are sanguine. I think they're still very constructive. And I think, and we are too, and that's definitely what we would hope to convey a bit here as well, is that certainly, cockroaches, that word has gotten a lot of attention. But I think even as we've talked to people at JP Morgan, they've kind of tried to back off, what that really means in terms of the broader market. Yes, there have been some instances of fraud. The 3 of the 4 kind of well-known ones have been part of the banking system, not the private credit space. So yes, I think what we've seen is dispersion in credit performance. That's really been a theme. There's people that have outperformed, there's people that have underperformed. But really, if you look at the metrics overall, they're still looking pretty good. I mean, EBITDA growth is still solid. Revenue growth is still solid. Leverage is pretty okay. In terms of the BDCs, for example, we rate 33 BDCs. The loss rate in BDCs in 2025 was 1.1%. That's pretty in line with the long run average. And if you take out the 2 worst performers of those 33, the loss rate was 0.5%. So that's not signaling to us that there's any kind of widespread issues within private credit. There will be continued dispersion. That's our belief. And I think the banks are going to see that too.
We had a guest on a couple of weeks ago where we sort of posed the same question, and she said, "Listen, as long as earnings continue to run at this rate, which we're seeing, corporate earnings, sort of double-digit earnings growth, companies are covering interest." So,
right.
Exactly. And you've seen rates come down, and so interest coverage ratios have improved. I mean, look, everybody's really focused on kind of 2021 and 2022 vintages. And so if you look at those, where those were originated from a rate perspective, we're still above that. And so there's certainly companies in that vintage that are struggling. If you look at some of the loss curves historically, and in the BDC world in particular, that vintage is trending, closer to the worst one over the last kind of 15 years. So we are expecting to see some more issues there for sure. And who knows what happens with rates now with all the geopolitical issues and things like that. I mean, Fitch still expects a cut, 50 basis point cut this year, but yeah, there's still going to be some pressure on some of those. But for the most part, interest coverage has been moving up, which is helpful in terms of just credit performance.
Is there in private credit? Is there a refinancing wall? Macro guys that I hang out with they look back at a lot of this issuance during the COVID year, 2020, 2021, and a lot of it was sort of 5-7 year tenor, and they're going, oh, there's this massive refinancing wall, this is for regular credit. Is that a topic in private credit? Is that even an issue?
Yeah, I mean, in direct lending, I think for the guys that have been around for a long time too, I mean, the portfolio tends to be relatively equal weighted, I would say. I mean, historically, the duration of a private credit direct lending loan has been like 3 1/3 years. That has lengthened because the equity realization cycle has lengthened. And so you've seen that kind of get pushed out. But But part of the benefit of private credit too is that they have the ability to amend and extend. So you can see maturities coming in the portfolio, but
Right.
they're not saying just give me the keys. They will negotiate. They'll say, hey, sponsor, put some more money in. We'll push this out another 12 months and we'll take another 25 basis points of yield. So there is that partnership and the ability to work. A lot of people have talked about like software in particular, which I think we'll get to. If you look at like software maturities, if you look at the largest BDC, for example, which is $80 billion in assets, they have 0% maturing in their software book in 2026, less than 2% in 2027, and then it starts to pick up in 28 and 29. So I think, you are seeing some of that. A lot of these are 7-year loans, 5 to 7-year loans. A lot got originated coming out of the pandemic. So there is some concentration. Right. But if you get an M&A cycle, you're seeing these things refinance well before their maturity date typically. So I think everyone's just been kind of waiting for M&A to pick back up. Second half of last year was really good. We're much slower now again. So we'll see. But if we get back to a normal pace, then that should all be very manageable.
So Meghan, like amend and extend, is that a good thing or a bad thing? Because I've seen some of these high yield bonds where they do drop downs or double dips, liability management, they call it, which is just extending the time for a bankruptcy rather than solving the real problems of the company, right? Like, is that a good thing? Like, do you think when they do amend and extend, or would you count it as distressed debt?
So is it a good thing? Yes and no. So I think some are yes, some are, they're companies that are performing well, they're sponsor backed. The exit strategy is being delayed by the sponsor because of what's happening in the market. So there's just no one's agreeing on valuation necessarily. Right. No one wants to fire sale the asset. So if they have the flexibility to work with a direct lender to kind of amend that for a period of time and the company is still performing, they're still paying cash interest, right. They're not picking, all that stuff can be totally normal course. If it's the opposite and it's struggling and it can't refinance because there's credit issues, then that's something else. And then, you might start to see PIK, and we certainly see PIK increase or payment in kind income increase in the sector. But even right. that, you have to kind of disaggregate. Some is amendment related, some is structured at origination. But yes, there are certainly some instances where you have to say, are they just kicking the can down the road in terms of, credit right. issues that are developing in certain deals?
So payment in kind, like, I'm glad you mentioned it, like payment in kind is like instead of paying cash, you pay something else, right? But paying with more debt, does that even make sense? Like someone who owes you money, you're making him take on more loans, And...
Yes, it can make sense, but the lender gets their pound of flesh in exchange. So generally, right. if it's an amendment related deal, they will say, sponsor, you need to put more money in, and we're changing the terms. So maybe there's a yield enhancement that happens right. as well. In terms of the PIK at origination, we've seen that a lot over the last couple of years. That has been really a competitive tool for the private credit space against the broadly syndicated market. So you don't really see PIK in BSL deals. So that's been a way for them to win some of that. And that's an option at the borrower's, decision. So the PIK toggle is usually around for 2 years, and it is just an enhancement. So they're not saying, hey, let's say the cash coupon is 10%.
Right.
Now we'll go 8% cash and 2% PIK. No, the cash coupon is still 10%. And then the PIK is a yield enhancement on top of that. And so, right. We'll see. Some of those will start to play out in terms of expiring soon. But I think what we need to see too is that the M&A cycle, once that picks up, you'll see right. more PIK repayments of all the PIK that's kind of accrued over the last several years.
So actually, Meghan, I wanted to take a little step back. I wanted to check what is Fitch's role in private credit, right? Like, so I remember a time before where a lot of people were getting rid of credit research analysts or reducing their teams within the banks and the institutions. And like rating agencies like yours, which focus a lot on research and do a lot of credit work, have started growing in confidence. I'm sounding really old now, but it's like almost a decade back. But how is that? Like now you are probably the expert, you guys and the other top rating agencies are like experts in these markets because people rely on ratings, right? And so what is the due diligence process which you guys go through? So, and why should people have confidence in what the work you guys are doing?
Yeah, sure. I mean, the due diligence for one is the same, whether it's a private deal or a public deal, whether it's a
Right.
private rating or a public rating. We're always kind of getting the same information. I mean, I've been at Fitch for 20 years. I joined the non-bank team. It has grown considerably since then, as you've seen more kind of move into the non-bank space. And so, we have a long history kind of understanding the different asset classes that have been moving, more and more into this space. We work collaboratively with our structured finance group, ABS, the guys that really are even closer to the collateral. And so there's a lot of collaboration there for sure. So I think we have a lot of long tenured analysts who have a lot of experience. I was here for the GFC, with lessons learned as well. So I think it's really applying all of those things to kind of what we see. And understanding kind of what the risks
Right.
have been in the past and how to kind of think about them going forward.
Right. And like, what are the types of ratings? So there has been lots of discussion about the different kinds of ratings which are given to private credit. So one of them are like what I saw from your website. You have private monitored ratings, you have private letter ratings, you have public ratings on some of the private credit. So could you explain a little bit, like, because one of the things which I come across is that these private credit guys are private, right? Which is in the name. So the transparency is an issue, right? Like, they're not telling you everything like a public company would do, or you can get a lot of disclosures. How do you rate something which is based on someone saying, this is what I'm valued at?
Yeah. Well, the valuation is certainly kind of a whole separate conversation. But I would say, in terms of information, obviously, if it's a public company who's been around for a very long period of time, you have a lot of information. But still, if you are a private company, you have audited financials that you have to have. We look very much at track record. We're asking all sorts of questions about operational risk management, all of those things. So we feel like the threshold is the same, whether it's a private rating or a public rating. We do have a variety of different ratings in terms of private credit, because it cuts across so many groups at Fitch. I said we rate 33 BDCs. We cover all the big alternative investment managers, Blackstone, KKR, all of those guys. So we have some sense for kind of all the things that they're doing. We rate life insurance companies, who has gotten more involved in the private credit space. Our leverage finance team does a lot of privately monitored ratings, which you mentioned, which a lot of those are done for asset managers on behalf of insurance companies. So insurance companies need the rating for capital purposes. We also do a lot of credit opinions, and those are part of CLOs. So we rate middle market CLOs. Obviously, we do broadly syndicated loans. And then in the structured group, there's a lot of different things. I mean, you have subscription facilities, private equity, or not even just private equity, but collateralized fund obligations, NAV facilities. I mean, there's all sorts of things that kind of fit into that private credit bucket now. So we're constantly looking at criteria, developing new criteria, and enhancing existing criteria as we continue to get smarter on the space and see how things develop.
Right. And you mentioned lessons learned from the crisis. Even I covered the structured finance market before the subprime crisis and after it. And I kind of realized how little people knew about how the market operated, right? And so what are the lessons you have learned from that period when you worked, and how do you avoid the pitfalls? Because a lot of the private credit structures, I notice, are somewhat harking back to that period, right? So how do you get through that? And how do you respond to it as a rating agency?
Yeah. I mean, certainly the growth of the private credit market is something that people are constantly kind of pointing to with the subprime crisis and making that comparison. And we think there's meaningful kind of differences. I would say, I was in the non-bank team back during the GFC as well. And so liquidity is something that we were always focused on, but we're even more focused on now in terms of, stressing, understanding different markets. If you're shut out of the market, how are you managing liquidity? And look, liquidity is key today, especially as we see all these redemptions increase in the perpetual BDC. So that's something we're super focused on. I think in terms of underwriting, you're really trying to dig in and understand exactly what they're doing. There's, especially in a big growth universe, the thing that you think about too is getting adversely selected. So who's getting the full access to deal flow and has the ability to select the good credits, and who is just getting whatever everybody else passed on. And so a lot of that has to do with what's the platform, what's your track record, what kind of relationships do you have with sponsors in direct lending in particular. So it's really in digging into that and making sure, can we see your documentation? What are your valuation procedures? How do you backtest valuation? If you see something that got sold, at 50 cents on the dollar that was marked at par a quarter ago, how do you explain that? What's the reason for that? Is it really a one-off or not? So it really is just kind of digging in even more and understanding. And we saw the triggers and kind of what led to things in the past. So do we understand the interconnectedness within private credit?
Right.
And there certainly is. I think some of the things that give us comfort is we are not seeing or expecting a forced sale of assets. And that is what had led to issues, right? Because you see valuation declines rapidly and that affects everybody else who maybe is holding that asset. So you've seen like a couple of BDCs sell assets. Those, in our view, were not for sale of assets. And we can kind of dig into those if you want to. But the way that these are structured and the cap of 5% redemptions, there are other liquidity sources that they can use to meet those redemptions without having to sell assets. So we're not expecting, because of the structures of these funds, that that's going to be an issue. So there's a lot of differences that we see as well.
Right. And like one of the things, like, again, I'm picking on the subprime crisis days. Is there rating shopping in this market? Because if I was a company and I could get a better rating from someone as reputable as you, and I would do it, right? Why would I, what is that happening a lot, you think? And people competing with each other to give better ratings? How do you compete in a market like that?
Yeah. I mean, the way that we compete is just sticking to our knitting, because the big three in particular have kind of lived through it before. Obviously, there were reputational issues at the time, and we are all about our people. That is our biggest asset, and we want to make sure that we are being transparent and consistent. An A rating in corporate is the same as an A rating in public finance or structured finance. You should be indifferent, between those securities. So we need to make sure that we're consistent there for sure. I think obviously the insurance companies are doing more in private credit. And so there is more demand for ratings on private credit deals as a result. And so I think there's certainly a lot of debate about that. All we can do is continue to stick with our criteria. We do develop new criteria as we see growth in different pockets of the market and structures that maybe don't fit in existing criteria, but we're not going to bend or adjust criteria just for volume. We still have credibility is the most important thing for us. And so we're going to make sure that we are consistent and stick to what our criteria says to do.
So like even rating transitions, right? Like there was like, how quickly do you downgrade someone so that people can get out or have the option? What has been this, like, how is, like, at least now at this point when private credit, you have been rating it for a long time. How has your experience been? Like, have you been able to do it quickly and respond effectively?
Yes, I think so. And it's going to depend on, some things are event driven and some things are, longer term trends that you see developing.
Right.
We, in the BDC space, we have downgraded 2 BDCs in the last year to sub-investment grade. Both of those were kind of longer term trends. Both had been on negative outlook before. And so if we try to kind of get ahead of it to signal, especially if it's a trend that's happening, hey, if we don't see improvements in X, Y, and Z, then this thing is probably going to get downgraded. And so we do try to do that. It's rare that we downgrade just off of a stable outlook. That's not what we want to do, because we want to make sure that we're signaling kind of where things are not meeting our sensitivities.
Correct.
And so we do try to signal that.
So, I think people misunderstand the whole rating transition thing a bit. At least that's what I think is, because they expect rating agencies to immediately cut everything when the markets are bad, right? But they forget that you always have a forward outlook, and you put a rating based on where you think the stress sensitivities are, and that's your basic due diligence. You can't just turn around tomorrow and say, no, we were wrong with everything, and now cut it, right? Like, how do you manage it? Right. How do you manage
we want to rate through the cycle. So, and I think our job is to play devil's advocate. We're always looking at the downside. And so the perpetual BDCs, for example, we rate 8 of them. And so you're seeing redemptions above 5%. And most of them have held the line at 5%, which is what we expected to happen. That's why the cap is there. But we're not downgrading or taking negative action on those because that was part of our base case. It was, how can they withstand 5% redemptions for a long period of time? Do they have the liquidity flexibility to be able to meet those? And the answer was yes, and that's why we're there. So we need to be thinking about all the possibilities when we're underwriting or rating something from the get-go.
Does your rating or does your rating process, does it start from does it involve macroeconomic outlooks, and does it start from we're in an inflationary environment, or we're in a slowing growth environment, and therefore these companies are perhaps more sensitive to the outcomes, to that macroeconomic outcome? Do you start from that point, or is that a consideration along the way?
We absolutely start from that point. We have operating environment kind of viewpoints for each of the subsectors that we rate. We have economists in-house. We do a quarterly global economic outlook. And so we use that as our backdrop for everything that we're rating. So we, especially at NBFI, non-bank FI, we pay a lot of attention to where rates are going. I mean, most of the businesses we cover are very U.S. focused, but they might have some exposure internationally too. So then we're focused on the health of those economies, GDP growth rates over there as well. So that is the starting point for sure. And that is where we try to maintain consistency too. And so if the global economic outlook too is updated on a quarterly basis in a meaningful way, we will also, as a subsector, put out reports to say, what subsectors do we think are the most exposed or most impacted by the change in the economic outlook?
Right.
And I know you answered it in a different way earlier. Is there a risk of financial contagion from private credit? You think, is there a possibility? Like, are we going to see another subprime crisis, but through private credit?
Fitch thinks no. I mean, we get the question all the time, is this systemically important? Is private credit systemically important? We think it's systemically relevant. I mean, it's getting bigger for sure. But given the structures of these vehicles, having a cap, most of these funds are levered relatively low. So BDCs are capped at 2 times the most, or 1.25 on a debt to equity basis or below. You also have, other funds, direct lending funds and things like that. Most of them are levered relatively low as well, 1 times or below. Some have no leverage. So we feel good. And the biggest thing, as I mentioned before, the forced selling of assets and which could have ripple effects in terms of valuation. We just don't see that as a necessity, just given the cap and the way that leverage is managed in some of these semi-liquid structures. You have growth in other things like interval funds as well. And so it really is kind of understanding how is each of those managers thinking about liquidity, because there's nuances between the structures. Perpetual BDCs can gate, interval funds cannot. So it's making sure you understand that. And we have so much focus now on retail investors. Alt managers are certainly targeting those. I think you need to think about, I think the regulators are going to be thinking about suitability. Do real retail investors really understand what they're investing in? And I think just given the last couple of months, in some ways, the answer to that is no, because they're redeeming so quickly, even though we don't see meaningful deterioration in credit performance in these vehicles.
Right. So that is always a danger. Like, do you think moving into retail is a good thing, or this should be basically an institutional product rather than involving people like me?
Well, listen, I mean, that's all for traders. That's always a red flag, is when the institutions go, yeah, let's sell some of this stuff to retail.
Yeah.
Right.
Yes. Yeah. And I guess from our seat, like we wouldn't say necessarily, like, that probably isn't our place to say whether they should be doing it or not, but we kind of say they are doing it, and what does that mean, right? So from a liquidity perspective, if there is a lot of retail investors, they tend to be maybe more momentum based. And if they see the headlines, that's going to drive some outcomes. And it's interesting because you see institutional investors still committing to these private credit direct lending funds. You can see the fundraisers that are getting announced. And so the institutional investors still appear to be very much believing in these direct lending products, and retail investors just tend to think, oh, got to get out. Everybody else is getting out, so let's get out. So it is a run in some ways, but it's contained because there's a cap on how much you can redeem every quarter.
Right. But Sorry,
Sorry, Shanks. I mean, the business development companies, especially had a huge bounce in the market this week, 10, 12% up. And do you think that the marketplace is sort of reevaluating their negativity on private credit? It seems to me, rather than as opposed to, oh, this is a short squeeze in the market, blah blah blah. But it just seems to me, from what the banks said about private credit and what you're saying today, Meghan, is that maybe the market sort of went off the edge and got too bearish and on the outlook for the private credit sector, and maybe this. So I guess I'm asking myself, maybe this bounce that we saw this week in BDCs especially is more durable than just a short squeeze in the market.
Yeah, I think, and I hope people are encouraged by the fact that you see these BDCs holding the line at the 5% cap. So you saw a lot more go above that 5% in the fourth quarter. And ultimately, I think they realized there's no benefit to that, right? It wasn't like stopping, the headlines and all of that. So I think they realized they have a fiduciary duty to existing investors, those that are staying in as well. And so they need to be thinking about how they're managing liquidity. And I think because we're seeing inflows come down, that should help from a supply-demand dynamic. Right. And then maybe you start to see spreads widen, and then it's a good time to deploy capital, which is good for your existing investors. So you want that capital to be there to be able to benefit your existing investors as well. So I think that's certainly part of it. I think there's been a lot of research that, we have tried to put out, and others as well, just trying to say, hey, software is very much in focus. We put out a report saying if you write off 25, 50% of the BDC software exposure, they're still in compliance with their asset coverage requirement under the 40 Act. So, and no one thinks they're going to lose 50% of their book, hopefully. So I think it's a pretty egregious stress, but we're trying to just level set for people a little bit. Like, this is the worst case scenario. So hopefully people are getting a little bit more constructive. I've been at some conferences recently too, where people are kind of addressing a lot of this stuff head on and talking about, we just aren't seeing the deterioration. And even in the software book, here are the metrics. They still look pretty good.
Yeah. Shanks had a guest on, Steve Booth from T. Rowe Price earlier in the week, and he made the point about software. They said that they think the sector is mispriced on the downside, right? And it seems to me that, again, in software, software names this week, you saw a huge bounce, and it just seems like the macro community is reevaluating their negative stance on those sectors.
Certainly, there will be winners, there will be losers.
Yeah, right.
The sector's not going down.
Yeah, nice trade, by the way, Steve. Right? He said that before the market bounced. Anyway,
so actually, Meghan, one more thing, like, everything can't sound good all the time, right? Like, which is what these markets are. For the last 2 decades, all I'm hearing is it's all going up. It's all going up. Even when high yield was in stress, there were lots of liability management exercises which were supposed to just tame bankruptcy. And then suddenly everyone is like, oh yeah, let's go back into high yield again. Like, what are the red flags which will really alarm you? Like, I'm sure you guys have a view 3 years, 5 years down the line on anything. So what are the thing which makes you sit up and go, shucks, we got to go?
Yeah. Well, I mean, the differentiation is clear. I think that's what we really need to understand, is that, we downgraded BlackRock TCPC, excuse me, and FS KKR Capital Corporation to sub-investment grade, because their credit performance is an outlier to the negative. You see the 1.1% average losses in 2025, that ranged from 1.5% net gains to 17.9% net losses. So there is a meaningful dispersion in terms of performance. So it really is understanding how conservative is a manager in terms of putting things on non-accrual. Right. Ares Capital Corporation, who is the longest tenured BDC, for example, been around since 2004, they historically have above average non-accruals, but they have the best track record in credit. They have net realized gains over time. So it's just understanding that and how the management team kind of executes what they say they're going to do. And so that's part of it. PIK is something we're certainly focused on, because with that too, if you look at paid in-kind income as a percentage of interest and dividend revenue at the BDCs, also huge variability. It's like 1.5% to 19%. So then you have to dig in and say, how much of that is related to, structure and origination versus amendment? you saw some BDCs for fourth quarter earnings in their conference calls give some more detail about that. So there, we saw a few say, hey, we're 90% structured, 10% amendment related. If you go back, 5 quarters ago or so, FSK said they were 50-50. So, and that's not surprising just given their credit performance, right? So I think we get more, there is a lot of transparency in the BDC space. We get even more on a confidential basis. So we're trying to dig in and understand what the underlying portfolio company metrics are. And we just published a report actually at Transparency Monitor because we're trying to get those metrics out there in a very digestible way too, so people can understand the differentiation between those 33 BDCs. So
I guess more information helps people make a better, judgment as well, right? That's
absolutely.
I think that's a lesson learned from the crisis, I guess, because in crisis, it was hard to get information. So people overreacted or reacted less or reacted slow. But now after that, you have a lot more reports going out, a lot more interaction with the market explaining. So that's, I feel.
And we try, ultimately we're here for investors. That's who we're trying to serve and answer their questions. And so we want as much of that out there as possible. And it is obviously it's a great exercise for us to be doing constantly internally as well, just keeping checking, testing, stressing different portfolios all the time.
Right. So actually, I have a personal question to ask as well. Like, whatever you explained your work is, it's so complicated. You're talking about so many aspects of the financial markets which you have to think of before you make that call, and everyone depends on that call. So it's a very responsible, pressurizing job to me. But how does one who's graduating from finance look to become the next Meghan Neenan?
Yeah, I'm not sure my parents understand what I do for a living. And it's been 20 years here. So I try to explain it. But yeah, I think you have to have a passion for analyzing and digging into companies. I wanted to be an accountant originally because I loved math. I loved working with numbers and kind of fell into this after being a bank examiner and doing some equity research. So I think you really have to be willing to kind of ask the tough questions. We have great access to management here. We get a lot of confidential information, as I said, but you have to be willing, no matter the level of someone in a management team, to push them on inconsistencies and also some of the stresses that they're doing internally. Well, how have you thought about this or these interconnections as well? And all of that just comes with experience and having great mentors over the years. And hopefully I do that with the younger folks as well, because they bring great ideas. And so they're always kind of pushing me to learn new things and look at things in a different way too. So I think it really is, if you like to ask questions, if you like numbers and digging into those details, I think you can have a successful career here.
Right. And do you think AI will disrupt your career? Like some robot will take over all this?
I hope not. I hope at least that's how my kids get through college. But I think AI is going to enhance what we do for sure. It'll make things more efficient. It'll make a lot of the information more digestible. Obviously, we need to still kind of check certain things to make sure that AI is not missing critical information when they're looking at things. But look, if we have like 100 conference call transcripts to read in a quarter, AI is super helpful in that regard in terms of picking out some things. I think we will use it as a tool. And I think others will probably do that as well in terms of kind of arriving at ratings. Because we try to be very transparent in our criteria. We have benchmark ratios. And so AI can use the numbers to get to something. But at Fitch in particular, we focus very much on qualitative overlays. What are our gut feelings? How do we get to know the management team? Do we think that they're being, upfront? Have they been consistent? So some of that is just hard to pick up by a machine, right? So I think the experience still is critical. But I think in terms of a lot of the day-to-day prep work, the data work, some of that, I think will certainly benefit from AI over time.
Well, that's great.
Okay.
Megan, I learned like 100% more about private credit than I knew an hour ago.
Oh, so, good.
Thank you.
Here. I've been covering it for years. I didn't realize how hard a job is.
It's fun. It's fun. At times like this too, in particular, we are even more happy to try to help people kind of cut through the details and really get to the core of what's going on. So that's kind of our job, and we're happy to do it.
Yeah, listen, from a macro point of view, you see it, you see like some BDC, some fund, gating redemptions or something like that. And, macro guys like me just sort of oh, here we go, you know, the housing crisis all over again, right? Without really understanding, you know, the nuts and bolts behind it. And,
Yeah.
you know, what you've explained, I mean, it puts it in a completely different perspective for me, you know, and
Well, I think because people think that, you know, I think you probably have heard this too, that the memory is short in financial,
right,
kind of
right,
like,
right.
but it does feel like there have been lessons learned and there have been some changes. It doesn't mean there's not going to be issues
Sure.
or bad performers, because that is certainly going to happen. But hopefully that is just more lessons then that people can apply as they continue to grow and manage through around different operating environments.
Yeah.
So thank you very much for that, Megan. I think that's the time. I think we exceeded a lot of time, but it was one of the most interesting discussions we had. And I learned so much about private credit now. And thank you very much for that. And to our listeners, thank you for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts, and tune in next week when we dig into more such interesting topics and with more special guests. If you want to receive real-time reports and market data, you can request a free trial of IGM services. I don't know why they're not doing it already. Do it. Even I have kids going to college. So the link so the link is in the show notes. Thank you again, Megan. Thank you very much.
Thanks, Megan.
Thank
Appreciate
you for
it.
having me.
And have a great weekend, guys. Thank you.
Thank you.
It's good.